Why 95% of traders lose money and how to avoid it. Introduction. Imagine entering a profession where 95 out of every 100 people fail. Would you still do it? Most people would probably say no. Yet every year, millions of people around the world start trading Forex, stocks, crypto, and other financial markets. Many enter with dreams of financial freedom. Some hope to quit their jobs, others want a second source of income. But the harsh reality is that most traders never become consistently profitable. Why? Is trading a scam? Are markets manipulated? Or are traders making the same mistakes over and over again? In today's video, we'll explore why so many traders lose money and, more importantly, how you can avoid becoming one of them. Let's begin. Chapter 1. The shocking statistic. You've probably heard the claim that 95% of traders lose money. While exact numbers vary by market and broker, one thing is clear. The majority of retail traders struggle to achieve long-term profitability. That should immediately raise an important question. If trading is so accessible today, why do so many people fail? The answer is simple. Most people approach trading the wrong way. They treat it as a shortcut to wealth. They focus on profits before learning the skills necessary to survive. The market rewards preparation, discipline, and patience. Unfortunately, most beginners bring excitement, emotion, and unrealistic expectations, and that's where the problems begin. Chapter 2. Why most beginners enter trading. Most beginners don't enter trading because they love financial markets. They enter because they want freedom. They see luxury cars. They see social media screenshots. They see traders claiming to make thousands of dollars per day, and they believe success will come quickly. But trading is not a lottery ticket. It's a skill. Just like becoming a doctor, lawyer, or engineer requires years of learning, trading requires education, practice, and experience. The problem is that many beginners skip this stage. They want results before building the foundation, and that often leads directly to losses. Chapter 3. Mistake number 1. No risk management. This is the biggest mistake in trading. Many beginners focus only on profits. They ask, how much can I make? Professional traders ask, how much can I lose? Without risk management, even a good strategy can fail. Imagine risking half your account on a single trade. One bad decision could destroy months of hard work. Successful traders understand that protecting capital is their first priority. Many professionals risk only a small percentage of their account on each trade. Why? Because survival comes before growth. If you protect your account, you always have another opportunity tomorrow. Chapter 4. Mistake number 2. Overtrading. Many beginners believe more trades equal more profits. This couldn't be further from the truth. Professional traders are patient. They wait and wait and wait some more. Then they act when the right opportunity appears. Beginners often do the opposite. They trade out of boredom. They trade because they feel they must be doing something. They force opportunities that don't exist. The result? More mistakes, more emotional decisions, more losses. Remember this. The market will always provide another opportunity. You don't need every trade. You only need the right trades. Chapter 5. Mistake number 3. Chasing profits. One of the fastest ways to lose money is becoming obsessed with profits. When traders focus only on money, they become impatient. They start entering trades that don't meet their criteria. They abandon their trading plan, and they begin taking unnecessary risks. The irony is that chasing profits often pushes profits further away. Successful traders focus on process, they follow their rules, they manage risk, and they allow profits to become the result of good decisions, not emotional decisions. Chapter 6. Mistake number 4. Emotional trading. Fear and greed are two of the most powerful emotions in trading. Fear causes traders to exit winning trades too early. Greed causes traders to stay in positions too long. After a loss, fear may prevent someone from taking the next valid setup. After a win, greed may convince someone to risk too much. The market doesn't care about your emotions. It moves according to supply and demand. The more emotional you become, the more difficult it becomes to make rational decisions. This is why successful traders develop discipline. They follow their plan regardless of emotions. Chapter 7. Mistake number 5. Unrealistic expectations. Many beginners expect too much, too soon. They want to double their account in a month. They want to quit their job within weeks. They expect every trade to be a winner. These expectations create pressure, and pressure creates poor decisions. The truth is that becoming consistently profitable often takes much longer than most people expect. Successful traders understand this. They focus on progress, not perfection. They understand that losses are part of the journey, and they stay committed to continuous improvement. Chapter 8. What successful traders do differently. If most traders lose, what separates the winners? First, they manage risk carefully. Second, they remain patient. Third, they follow a trading plan. Fourth, they review their mistakes. And fifth, they think long-term. Successful traders do not chase excitement. They focus on consistency. One lesson often associated with successful investors like Warren Buffett is protecting capital. Before trying to make money, focus on avoiding unnecessary losses. That mindset alone can dramatically improve trading performance. Chapter 9. The path to consistency. Consistency doesn't come from finding a magical strategy. It comes from repeating good habits. Keep a trading journal, review your trades, track your mistakes, follow your rules, focus on learning rather than earning. Over time, small improvements begin to accumulate. This process may seem slow, but consistency is what separates professionals from amateurs. The goal is not one amazing month. The goal is sustainable performance over years. Chapter 10. How to avoid becoming part of the 95%. Let's summarize. If you want to avoid becoming part of the majority that struggles in trading, learn before risking significant money, use proper risk management, avoid overtrading, control your emotions, set realistic expectations, focus on consistency, keep learning, and most importantly, be patient. Trading is not a sprint, it's a marathon. The traders who survive are usually the ones who remain disciplined when others become emotional. Conclusion. The reason most traders lose money isn't because trading is impossible. It's because many people enter the market without preparation. They chase profits, they ignore risk, they let emotions control their decisions. But the good news is that these mistakes can be avoided. Success in trading doesn't come from being the smartest person in the room. It comes from discipline, it comes from patience, and it comes from consistently making good decisions. Remember, you don't need to be perfect. You simply need to be better than the habits that cause most traders to fail. Thank you for watching, and if you enjoyed this video, don't forget to like, subscribe, and continue your journey toward becoming a more disciplined trader.